Good afternoon, ladies and gentlemen. This is Eugene. I'm a portfolio manager at Signet Financial Management, and I would like to update you on the stock market this November 2018. Please take a look at our disclaimers and disclosures. All right, so today we will speak about U.S. equities. I will update you on the size and style dynamics. We'll take a look at the yield curve and valuation spreads, and we'll talk about the sector forecast we have for the next year, and also we'll dive into micro factors on company level to see which one worked and which one didn't this year. Finally, I will update you on the changes we made to strategic all equity portfolio and strategic dividend equity portfolio. Overall, this year, global economy has been growing at a healthy 3.1% annualized. U.S. is growing at 2.9%. And for the next year, the growth is projected at 2.9 for the global economy and 2.6 for the U.S. Recently, markets lost the direction, so to speak, and we didn't see clear leadership in the marketplace. Looking at the fundamentals of U.S. companies, we still see them very supportive for equities to appreciate in the long run. But that said, we need to stay selective and buy into strong fundamentals. As you know, recently revenue growers and hefty valuations got hit, and we believe it's time for more of a growth at reasonable price quality stocks to take over the leadership in the marketplace. We also think recession is not imminent, but it does make sense to become a little more defensive. This is our traditional value growth dynamic. You can see that for the last couple of years, growth has been dominating the marketplace. Recently, we had a blip of value taking over, but overall, it's been a growth market. Judging by valuation spreads, and here what we do, we take a whole bunch of valuation factors and we compare those of expensive stocks to those of cheap stocks. And you can see that the difference between, and that's what we call the spread. The spreads have gone up quite a bit recently, and they're below the two major events when spreads were even higher at the IT bubble burst and during the Great Recession. So I don't think we're looking at the same extreme conditions which developed back then in those two instances. So we are looking at a very major market which is stretched from valuation standpoint. From the size standpoint, we do have small companies kind of stepping back a little bit and pausing after the market realized that small companies are actually exposed to tariff debacle and not shielded from that completely. On the 3-year moving average, we're looking at the neutral posturing, and that's why we take a pretty substantial position in mid caps as kind of the mid ground between large and small companies. So everybody's talking about the probability of recession going into 2019, 2020. Judging by yield curve slope, which usually gets inverted, becomes negative prior to recession, happening usually a year and a half prior to recession. We don't see that yet. The yield curve is actually positive. It has been flattening, but there is a probability of it actually steepening should Federal Reserve be less aggressive with interest rate hikes in 2019. Credit spreads are also at a very subdued level. Nothing is pointing to a recession yet. We also look at the shorter-term interest rate spreads, which are a leading indicator to, the traditional yield curve, which is the difference between 10 and, and 3 months rates. So, and you can see that the short-term interest rate spread also goes negative prior to recession, and we don't see that at the moment. Judging by our macro forecast, we have a very interesting combination of defensive and cyclical sectors which are forecasted to outperform over the next 12 months. We'll have staples, healthcare, and utilities. Those are classic defensive sectors. And at the same time, we do have consumer discretionary, IT, and communication services, the newly created sector, which are forecasted to outperform as well. So it's a very interesting barbell combination between the defensive and parts of cyclical sectors. On the negative side, we see a whole bunch of classical sectors, classical cyclicals like energy, financials, industrials, materials. We also see real estate negatively impacted. But with regards to financial, again, it's pretty interesting. They've been suppressed. People expected them to do much better because of rising interest rates. But I guess the flattening yield curve kind of suppressed financials. And they represent great values right now. So should Federal Reserve be a little less aggressive next year with interest rate hikes, we probably could see some financials perk up, and banks in particular. So this is pretty much the same kind of this slide emphasizes the true, real, strong sectors, healthcare, staples, utilities, and the less attractive sectors, energy, industrials, and materials. And you can see from the progression year out that it's been pretty stable forecast. So with valuation spreads getting stretched, the leadership is kind of mixed right now because of high revenue growers stepped back a little bit in the last couple months. We see real change in the leadership, and we believe growth at reasonable price companies should step in, and valuation should play a bigger role. From the fears of imminent recession, when you look globally, the conditions usually which are needed for recession, like margin compression or banks becoming very conservative, are not met yet. So at this juncture, we don't see recession happening in 2019. And we also have blue chip forecast, and that's the survey of 50 most prominent financial world institutions. And the forecast actually doesn't point to a recession in 2019 either. And we validated the forecast with PhDs from Wharton this summer. So it's a pretty trustworthy publication. So let's look at the micro factors, the factors which influence the returns of companies. When we look at this heat map, we compare the best companies, the best 40% of companies in each, broad factor category. And usually we want companies, with good value, reasonably priced, with good valuation. The companies which are profitable, which have positive momentum, good growth prospects for sales, for earnings, for free cash flow, and good safety. So historically speaking, a combination of these factors worked in the macro score, and 2017 is a good example of that. you can see that value has been out of favor for a long time, and value actually does not necessarily determine the efficiency of the score if other factor groups support the score. And 2017 was an example where the factor groups other than value and yield actually contributed to positive score. 2018 is totally upside down. Pretty much since the end of March, when the trade war was announced, all the factors are flipped. So it's first half of the year, through probably August, the small group of high sales growers dominated the market. Then the market lost direction and tried to hide into safety. And you can see that September, October, safety really perked up. But from our point of view, when we look on the sector by sector basis, we pretty much see the picture where the market prefers the companies, more expensive companies, less profitable companies with no momentum and less growth prospects going forward. So and that's not just the sales growth, right? That's a combination of free cash flow growth and earnings growth. So it's kind of a very upside down market. Usually it doesn't last that long over the last 20 years, and we also pointed it out in our white paper. We shared with a whole bunch of you the paper from a big institutional money manager, EQR, with the George Costanza portfolio paper, and they demonstrated the same pretty much thing, that this year fundamentals really were kind of thrown out at the moment. Usually the market comes to senses. We see valuation spreads stretched. We don't see imminent recession, so should the market realize the scenario is either no recession or at some point we'll have a mild one, we should come back to fundamentals and the market should pay more attention to those. So with the efficiency of the score this year, none of the sectors really work for us other than real estate. So which tells us across the board that it's more of a systematic, not a problem with outweighting one sector or making a poor individual investment decision. Yeah. So in our strategical equity portfolio, we kept the mid-cap tilt. We still have a neutral posture with regards to value growth, but we really emphasize GARP, growth at reasonable price. The newly created communication services sector, received a whole bunch of our IT stocks, a whole bunch of consumer staples stock, consumer discretionary stock. So we found ourselves overweighted in communication services, so we decided to reduce it a little bit. We still stay overweight in it, but just reducing the overweight. We also bumped up the discretionary crossplay with BABA, pretty much upping it to a full position. We closed the gap in consumer staples with BGS becoming a full position, and reduced energy a little bit. Keep financials with the exposure to banks, and SunTrust is the bank we added. And I talked about financials already. We are hoping for them to perk up. And we closed the gap in IT by introducing Citrix. Not a huge rebalancing, 10% of the portfolio, in line with our philosophy of holding stocks over a 3-year period. So this year the turnover was about 30%. So you can see that we are very well diversified in all equity portfolio, and the diversification pretty much covers all the major sectors, and we are within the benchmark parameters here. From the size standpoint, we have pretty good representation of large cap growth per our classification, but if you look at Morningstar classification, it's more of a blend, meaning that we are much more tilted towards GARP. And we have very good mid-cap presentation. Strategic dividend equity portfolio didn't experience that many changes. We reduced energy, bumped consumer staples a little bit, and so changes are really minor. Again, strategic dividend equity portfolio is very well diversified with all the sectors, and pretty good combination of growth and value. Value is obviously a little more represented here, but blend again is a pretty good group, pretty sizable group. So we do hope that GARP works out, and we still have a pretty good, healthy medium cap representation in the portfolio. So overall, just to kind of conclude the presentation, I would like to say that we do see the conditions for our portfolios to appreciate going forward. We've collected great companies with great combinations of you know, the characteristics which work out in the long run, and we see that appreciation potential for our portfolios as much higher than the market averages. If you have any questions about this presentation, please don't hesitate to reach out to me. My name is Eugene Yashin, and my email is eyashin@signetfm.com. Have a great day.